Stock, a share of ownership in a company. Each unit of a stock is called a share. So for example, if this pizza was a company, each slice would be a share. Equity. The more shares you own, the higher your equity. If you own more than 50% of the slices, you'll get to call the shots on the toppings of the pizza. Shareholder. Anyone who owns a share. So if your friend owns 4 slices, or in other words 40% of the company, they would have a strong say over the final toppings. Share price. The price people are willing to pay. If pizza becomes popular, price per slice goes up. If pizza gives everyone food poisoning, share price goes down. Other factors that influence price are news, hype, the industry, or Elon Musk writing a tweet. Stock exchange, a place where people can buy and sell stocks. A bit like a food court but for shares. Investing versus trading. Investing is holding shares for the medium to long term. Trading is buying and selling quickly. Day trading. Buying and selling within the same trading day. The aim is to make a profit from the daily price movements. Going long. Holding the stock for a longer time period because you think the price will increase over time. Swing trading. Holding the stock for the medium term, somewhere in between day trading and going long. Dividends. If pizza company makes a profit, or let's say has extra slices, it may distribute these to its shareholders in the form of dividends. But not all companies pay dividends. Dividend yield. Dividend as a percentage of the stock price. For example, stock price is $100, dividend is $5, that's a yield of 5%. Bull and bear market. A bull market is when prices are rising. A bear market is when prices are falling. They are named after each animal's attack style. Volatility. How much a stock moves up and down. High volatility, think roller coaster. Low volatility, think merry-go-round. Rally. When share prices are continually increasing for a period of time. This could be one company, one sector, or the overall market. Pullback. A small dip after price going up. For example, stock increases from $15 to $20, then drops to $19. Correction. When the share price or market drops between 10 to 20% from recent highs. Support. The level where the stock price tends to stop falling. Resistance. The level where the stock price struggles to go above. Breakout. When a stock finally breaks through the resistance level. Technical analysis. Looking at charts and patterns to predict stock movements. Market sentiment. The overall vibes in the market. Fundamentals. The strength of a company. Key indicators include revenue, profit, debt, growth and business model. Efficient market hypothesis. A theory in financial economics that asset prices reflect all available information, making it impossible to consistently beat the market. Insider trading. Buying or selling assets using undisclosed or non-public information, giving an unfair advantage over other investors and undermining market integrity, making it illegal in most countries. Liquidity. How easily and quickly an asset can be bought or sold in the market. Portfolio. The sum of all your investments. Diversification. Buying different types of asset classes. In theory, the more diverse a portfolio, the lower the risk. Blue chip stocks. Shares in large, well-established companies with a history of reliable performance. Think Apple, Google, Coca-Cola, and so on. Penny stocks. Cheap stocks in smaller companies. Volatility and risk is usually higher compared to more stable blue chip stocks. Bonds. When an investor loans money to a company or government and in return gets regular interest payments and the promise to get back the principal on a specific date, which is also known as the maturity date. Default risk. The risk of not getting your principal back if the issuer of the bond defaults. Corporate bonds generally carry a higher default risk than government bonds. Options. A contract which gives you the right but not obligation to buy or sell a stock at a specific price but before a specific end date, hence the name option. In other words, you don't have to exercise this option if you don't want to. If you're buying using options, it's called a call option. If you're selling using options, it's called a put option. Call option. Used when investors think the price will go up. For example, pizza company stock is currently $100, but I have a call option, which lets me buy the stock for $110, which is also known as the strike price. My prediction comes true, and the share price increases to $150, so I use my call option and buy the stock for a discount at $110. Put option. Used when investors think the price will go down. For example, market price for pizza stock falls to $40, but I use my put option and sell the stock at a strike price of $50. Futures. A financial contract which obligates a buyer to purchase or a seller to sell a stock at a specific price and date in the future. For example, as the owner of my pizza company, I currently pay $5 for 1 kilogram of cheese. I'm worried that next month the price will increase to $10, so I use a futures contract to lock in the price at $5 for next month. If my prediction comes true and the market price increases to $10, then I've just saved myself $5 per kilogram. But if I'm wrong and the market price drops to $3, then I'll be overpaying, as I'll be obligated to still buy at $5. Commodity. Future contracts are often used for commodities like oil, gold, wheat, and natural gas. Index fund tracks a specific group of assets or stocks. The most famous example being the S&P 500, which is the largest 500 US companies, meaning if you invested in this index, your money is spread across these 500 companies. Exchange Traded Fund, or ETF, a fund that holds a basket of assets like stocks, bonds, or commodities. They generally track a specific market index like the S&P 500, but can also focus on specific sectors or asset classes. Mutual fund pools money from many investors to buy stocks. The fund is actively managed by a fund manager who decides which stocks should be in the fund to maximize shareholder returns. Hedge fund, a private investment fund pooled from wealthy or institutional investors. Hedge funds are usually high risk, high reward. Forex, buying and selling currencies to profit from fluctuations in foreign exchange rates. Initial public offering, or IPO, when a private company goes public and is now listed on the stock exchange. Market cap, total value of a company in the stock market. For example, if the stock price is $10 and the total number of shares is 1 million, that's a market cap of $10 million. Short selling, where you borrow and sell a stock that you don't own. You're betting its price will fall, so you can buy it back at a lower price and return it to the lender, profiting from the difference. For example, you borrow a share at $100 and sell it back to the market, cashing in the $100. You later buy the same stock at $60 and return it to the lender, keeping the $40 difference. Short squeeze, when prices rise rapidly, forcing investors who are shorting to buy back the stock at a higher price so they can give the shares back to the lender and cut their losses. This pushes the price further, as all short investors are now buying the stock. Long squeeze, a rapid, unexpected price drop which forces investors holding long positions to sell their stock, triggering further price declines and a cascade of panic selling. Limit order, buying and selling stock when it hits a certain price. Market order, buying and selling right now at the current price. Security, financial instruments like stocks and bonds, or derivatives like options and futures. Day order, an order given to a broker to buy or sell a security at a specific price by the end of the trading day. If the specified price is not reached by market close, the order is automatically cancelled. Broker, a licensed financial individual or firm that connects investors to assets like stocks, bonds, or Forex. For example, online trading platforms. Stock split, company increases number of shares and price drops proportionally. For example, you own one share at $100. A 2-for-1 split would mean you now have 2 shares at $50 each. Companies do stock splits mainly to lower the price per share, making them more accessible for investors. Buyback, when a company buys its own outstanding shares from the open market or directly from shareholders, making the remaining shares more valuable by boosting metrics like earnings per share. Earnings per share, or EPS, company profit divided by number of shares. In other words, how much profit belongs to each share. For example, if the stock was $100 and the company made a profit of $1,000, the EPS would be $10. Price to earnings ratio. This tells you how expensive a stock is compared to how much money the company makes. It is calculated by dividing the stock price by the earnings per share. Let's say stock price is $100 and the EPS is $10 per share. That's a PE ratio of 10. This means the stock price is 10 times its earnings, or in other words, you're paying $10 for every dollar the company earns. Bid versus ask. Bid is the maximum price a buyer is willing to pay for an asset. Ask is the minimum price a seller is willing to accept for an asset. The difference between the two is known as the spread. Pump and dump, spreading false or misleading information to create a buying frenzy that will pump up the share price and then later dump the shares by selling at the inflated price. Ticker symbol, abbreviations of publicly traded shares usually in a unique arrangement of 1 to 5 letters or digits. Dollar cost averaging, an investment strategy where you invest a fixed amount into a specific stock or fund at regular intervals. For example, $100 every month regardless of the share price. This approach reduces the impact of market volatility by buying more shares when prices are low and fewer shares when prices are high, helping to lower the average cost per share over time. Compound interest, interest that is calculated on both the principal and the accumulated interest from previous periods. So effectively, it's earning interest on interest. This causes investments or debt to grow at a faster and exponential rate over time.